And so here's a chart here of the S&P. The yields went up to 1.6%. They pulled back about 4%. That's hardly the kind of thing where you could confidently say, oh, I really want to take advantage of this pullback and deploy capital. As we called it on the slide here, we said U.S. equities only wobble. So we're gonna, just so we can talk about what might happen next time, we're gonna review a little bit of what happened with the first wobble, and we'll also explain why we think we might have some more volatility going forward. Well, this slide here, what you have is I'm trying to show why do higher bond yields make equities a little bit less attractive. And here's an easy way to see it. For most of last year, right, or all of last year, you got a better return from dividends from the S&P 500. The S&P dividend yields were higher than the yield of the U.S. 10-year Treasury. So that's not really normal. Usually Treasury yields are a bit higher. It's not always, but usually they are. They were quite a discount. That tells you that equities are attractive versus stocks. But with the current surge in bond yields, bonds have sort of narrowed the gap. So they're less unattractive. Does it mean that buying U.S. Treasuries are more attractive than buying stocks? Absolutely not. Like right out of the blocks, that if you're buying stocks with dividends now, you're gonna, those dividend yields will probably, even in a bad case scenario, they'll keep pace with inflation. But if you're buying a 10-year bond, you're just locked in right now with that 1.57% type yield. So stocks are still more attractive than treasuries, but of course the gap is narrowed in, and the market also got a little bit nervous because how quickly the gap was narrowing it. Okay, here's a chart where we can look at it and I can tell you a lot of different things. I'm going to try to do a little bit of drawing here. Sometimes I fail when I do this. So the first complicated thing here, I'm drawing a little line on it, is this green line, the break-even line. The break-even line is the break-even of the Treasury protected securities, the TIPS. And that's the difference between the 10-year yield and what the yield is of the TIPS. And the difference between those two yields is our best market indicator of what future inflation is going to be. So the message from this is that this break-even line, basically from last year at this time, was saying that inflation was going to be around 0.9%. It's gone all the way up to 2.3%, right? So you've had a big increase on what our best market predicting idea of what future inflation is going to be has gone up quite a bit. So even though Treasury yields have also gone up a bit, they haven't gone up as much as inflation expectations. And normally Treasury yields are above the break-even line. So this gives you a good indication, or not a good indication, but this would be one of those arguments you'd point to say bond yields could go quite a bit higher, right? And then finally down here at the end, this goes back to the first thing I was saying about the relative attraction of bonds versus stocks. So rather than using this market indication of inflation, this is just using core CPI. And for the first time in a long time, you're getting a higher yield in the 10-year bond than the inflation rate, right? Basically, you're earning 10 basis points more than the inflation rate if you buy a 10-year bond or the core CPI rate. So does that make bonds very attractive? No, but once again, you're getting the message that I was trying to make is that the message I was trying to make is that that Treasury yields have grown a little bit more attractive, and that's hurt the equity market. So now we've sort of discussed a little bit about what happened last time. And the other important thing that happened last time is that the high growth and tech stocks badly underperformed when the market pulled back. So basically, I just wanted to put that thing in perspective. If you look at beta is basically, kind of a measure of risk. That if the S&P is the broad market, so it has a beta of 1. The triple Qs, which is the ETF that gets you the NASDAQ 100, has a beta of 1.04. So that basically says if the market goes up 1%, you expect the triple Qs to go up by 1.04%. If the market goes down by 1%, you expect the triple Qs to go down by 1.04%. So if you look at the returns year to date on March the 18th, when Jeffrey made this slide for me, the S&P was down 1.5%. So you would have expected, if there was nothing else going on, just based on their risk, the triple Qs to be down 1.6%, just a little bit of underperformance. But in fact, they were down almost double that, 3%, right? And then if you look at the ARK ETF, which we talk a lot about, Kathy Wood, which is sort of like kind of what's in vogue in the world, and she's buying all the new things, and she's very good at it, but it is thing, that has a very high beta, 1.65. But even with that high beta, you would only expect her fund to be down about 2.5%, right? But instead it's down 5.8%. So there's something else going on than generally just that these stocks are more risky, that they drop more. Well, another reason people say where they drop more is a lot of those high growth stocks aren't earning money right now. People are buying them because they have very high increase, that their revenues are increasing quickly and they're looked to make a lot of money in the future. So if it stands to reason, if interest rates are higher, if bond yields are higher, you kind of want companies that are making money now rather than making money a lot later. And if interest rates are 0, you don't care if the company's making money now. As long as it makes the money later, you're happy, right? Because the money today isn't earning you any money in the bank. So we just did a little calculation here. Once again, Jeffrey made this slide that if you had a bond with a 10% coupon and bond yields went from 10%, let's say this is a 10-year bond, Jeffrey should have labeled that, but if it's a 10-year bond and it went from 10 to 15%, that bond would drop by 25% in price. But if it was a 0 coupon bond that was yielding 10% and went to 15% yield, it drops by 37%. So it's dropping by 50% more. So that kind of gives you an idea that when interest rates go up, you're going to pay, you want something that gives you a dividend back now. You want something that gives you a coupon back now. But it doesn't explain the really big, I mean, that's 50%, but that doesn't explain the really big underperformance of those high growth Kathy Wood stocks and the ARK or the NASDAQ 100. So basically that sell-off that occurred in those stocks, that sell-off, it was due to something else. And the obvious explanation is those stocks had been big outperformers. And when people got nervous because bond yields were going up, they simply sold their winners. And that's why it underperformed. And that's a good thing for you to think about, because that will make you, since there's not an underlying problem, there's not a bubble probably being burst, that means that you can probably, if you do have a good correction in those stocks, you can quite happily go back to them and buy them. And those are the ones you want to own in the next correction. Okay, since I was talking about bonds here, I figured I'm going to take a chance again and try to draw again here. So here we go. I got the highlight penned. And here are 4 bond ETFs, 4 BlackRock bond ETFs. One here, you got the government bond one, You got the high grade corporate bond, that means investment grade corporate bond ETF, the high yield bond ETF, and the TIP ETF. So the first thing I want you to notice is obviously bond yields went up, uh, so that means the price of bonds dropped, and that's why you see the government bonds and the high yield and the investment grade bonds drop. But high yield bonds have shorter maturities than those other two types of bonds, so they're less affected by Treasury yields going up. But you would have expected them to be not to have such a great time if the market's getting nervous, because you would think, well, people would start getting nervous about credit because these are non-investment grade companies. That's why, sometimes they call high yield bonds junk bonds, but they held up very strong, right? They're only down a tiny bit. And that tells you that companies in the US, even though bond yields have gone up stuff, they're still able to borrow money very cheaply. And that's a real positive for the US market, right? So once again, if the markets get nervous and there's a correction, the fact that the credit market appears, at least so far, and I think it's going to continue to be strong, that'll give you kind of more, confidence that you can go in there and buy. And the last is the TIP ETF. And interestingly enough, people think, well, I buy this to hedge against inflation. And I should point out this gave good returns last year. But this year to date, it's down because bond yields have gone up. And then I'll take a little segue here because I was explaining that complicated thing, the break even. Well, you can see I just put 4 dots around. So if you're buying a TIP today, the yield is negative 0.5%. That sounds terrible. Why would you buy that? Well, because it pays you this extra kicker related to the inflation rate. So if inflation happens to be 2.2%, then you're going to get your yield out of the TIPS is going to turn out to be, 1.7%. Excuse me. 1.7%, the same as you're getting in the 10-year Treasury. That's the break even. So when people are saying, so if you imagine that the TIPS are a big liquid market and all these people are buying TIPS, and the people who are, buying the TIPS are saying, are willing to buy it at a negative 0.5% yield, they're basically saying we expect inflation to be 2.2% or better, or higher, I should say. Otherwise, we would buy a government bond yield. Just wanted to go through a real world example that we had from last time. So if you imagine I'd done that great presentation, I'd said bond yields are going up. I said if bond yields are going to go up, the market's going to get nervous. And one of my loyal listeners called me on the phone and said, should I buy Apple? They said it, and at the time they said, well, Apple's at 121. It's come down quite a bit. And I said, no, the S&P is only down 4%. It's too early in the correction. I know tech stocks have dropped more, but, in our presentation, we were really recommending the bank ETF, the KBE bank ETF, as a beneficiary of higher yields. We would stick with that. So that's what I told the person. And then she said to me, but it went down to like 119 the night before. And I was like, well, 119, Apple starts getting a little bit more interesting. But I kind of said, I still thought it was a little bit early. Now, subsequently, Apple even dropped some more. It went as low as 116. I don't know whether she bought or not. But after I was done talking to her, I was saying, well, if I were going to go for a tech stock, of course, it has a different risk profile to Apple. What I probably would have recommended was PayPal. And the reason, well, PayPal was obviously hadn't dropped on a year-to-date basis, but it had been up a lot higher. It had a larger drop. And I kind of liked PayPal. It dropped more from its peak. And on top of it, I thought it was very complementary to my recommendation of the banks. Because I said, well, you're buying the banks because banks are going up, because bond yields are going up, but you could buy PayPal because they're the ones kind of because these payment companies like PayPal and Square are the companies that are disrupting the banks and causing them trouble. They're basically earning money and making their revenue is coming by basically taking revenue away from other financial institutions, mainly the banks. And you can see this person here on YouTube actually created a YouTube called Kathy Wood Predicts Goodbye Banks. So I'm in line with that YouTuber. And to see how the results, basically it doesn't make a big deal difference, but if you look at the actual result, as you can see, that PayPal is the green line. It rebounded the most from the low on the first sell off. Um, you know, and then, but really the best advice was my first reaction, which was stick with the banks because they were benefiting from the higher yields. And also, the other thing that I wanted to talk about here is on that sell-off, there was one funny thing that happened. I was very fixated that, the higher bond yields would, affect things in the US, but China stocks during this period of time has had a much more serious sell-off. And whereas in the US, maybe the tech stocks dropped by 10%, but the S&P, the broader market, wasn't down so much. In China, both the tech stocks underperformed, but the broad market dropped a lot. So I think my bias would be also on that first connection. And also, if you're looking to buy something now, you should take a look at China because it really doesn't make sense to me why the Chinese market is coming off. And to give you an idea, this is simply because we discussed this at the last meeting. I had said that these stocks, of all this green investment, the thing that I liked the most was the solar panel makers, but they had gone up quite a lot. Xinyi Solar, of course, is the largest maker of solar glass. And you can see this has had a very big correction so far this year. So if you're looking at China and you wanted to look at, Ray is our next speaker coming up. And I don't know if he follows Chinese hedge funds, but, a lot of the highest performing Chinese hedge funds last year own Xinyi Solar and these other kind of green plays because they simply exploded in price in China. So here's one that's had a pretty good correction, and it's sort of the part of the market that I like because as we switch from internal combustion engine cars to EVs, it's going to create a huge demand for electricity, and the bulk and the biggest amount of the electricity, capacity of electricity is going to come from solar and wind. Now, this last slide, this slide here is basically just another reminder of why we think bond yields are going up. It's sort of a fundamental thing. When GDP is growing great, there's more demand for capital. Companies are doing well. GDP is growing. They have more demand for capital, and that pushes yields up. And this is just a chart that Bloomberg put in there. It shows that the predictions for U.S. nominal GDP for this year is 7.6%. Real GDP is when you subtract out the inflation rate. So if you think inflation's going to be 2%, that means GDP will be 5.6%. But nominal GDP, 7.1%. And then this compares it to the 10-year Treasury yield. And you can see it's just ridiculously out of whack, which tells you that GDP is just not historical, that GDP grows so quickly with bond yields being so low. So this would be another reason to believe bond yields to go up. If you were taking the other side of this argument, you would say, well, all this growth is coming from, kind of stimulus from the U.S. government, all this spending, under the relief package that the growth will be very transitory. So it'll be like a one-time shot. And if it's a one-time shot, maybe the bond yields don't have to go up so much. But based on history, it looks like bond yields need to go higher still. And so on that note, I asked Jeffrey to make the new chart for just sort of like the update of the one we had last time. And you can see that Jeffrey kind of put a line there at around 2.2%, where Jeffrey's saying, okay, that's our next target for yields. And he kind of also chose that because I kind of suggested that level. And basically what I'm saying is if we start going towards 2.2% in yields, that's quite a bit higher. But if we get up there, it's going to be more than just like before I said, okay, if yields go up, the market's going to get nervous. If we get up to 2.2%, it's got to be a lot more than nervous. We're going to really we'll really probably have a correction. And in that correction, I don't think the fact that banks are sensitive to bond yields, I don't think you want to be owning banks either. I think banks will correct probably just as much as the general market.